Hello, everyone. Welcome you to class. This video, I will be introducing my concept, candle matrix, and I would be showing you or teaching you a very simple way to identify liquidity by counting candlesticks. This is the very first public teaching on candle matrix and the very first public teaching on candle counting. Now, just to be clear, there is a concept out there that is built around the idea of counting candlesticks. That style of trading is completely different from what I am about to teach in this video. What you'll be learning from me the next few minutes is something that is 100% developed by me. And I have been trading this way for a very long time. So it's time to make it public. It's time to introduce how I identify liquidity and how I trade liquidity using candlestick counting. Without further ado, I would like to talk about something briefly before I share the logic behind how I identify liquidity through counting candlesticks. I would love to clarify, and I would also love to share the framework that leads to the logic. It is very, very important that you understand the framework because it would help you better understand the concept. Now, I understand that a number of traders would see this video, would see this teaching, and these traders would have different ways that they are already trading. Some would be trading SNR, Malaysian SNR, some would be trading ICT or CRT or, classic support and resistance. So this fact, right, is a reason why sharing this framework, the framework that leads to the logic of candle counting, it's a reason why it is important that I share this framework. Now, I would love you to do something for me. I want you to assume that everything I would be saying from now is correct and it's the truth. Now, I am not saying that what I want to share with you is the universal truth behind trading or behind technical analysis, but I am just saying that for the sake of this class, I want you to assume that everything I will be sharing with you is correct. And also for the sake of understanding this concept better, I want you to assume that everything that I am about to say is correct. Now, the first thing I want to mention is the existence of an algorithm. Now, I understand that this is something that is controversial. I mean, we have a bunch of traders that believe in the existence of an algorithm, and we also have some other traders that completely ignores the idea of an algorithm or the existence of an algorithm. Now, I want you to accept or just marry the idea that there is an algorithm that delivers price, that runs everything you see on the charts. I want you to accept that idea or marry that idea just for the sake of this class, right? Now, there is an algorithm. There is an algorithm 100% made by man, programmed by man, however you want to put it. There is an algorithm, and this algorithm is designed to facilitate institutional orders. This algorithm is designed to facilitate institutional orders. Now, I would have loved to go into much details of how this works, right? But this is just basic information if you're conversant with liquidity. So in short, what I mean is this is liquidity 101, right? There is an algorithm that facilitates institutional orders. So big institutions and big banks, they just cannot get into the market whenever they want or wherever they want, right? At whatever price they please, right? Because of the size of their orders. So there is an algorithm that helps facilitate these institutional orders. Now, this algorithm does this by creating, seeking, and destroying liquidity. I'll repeat. This algorithm does this by creating, seeking, and destroying liquidity. So every time you see price move, price is moving. You know, it is geared by an algorithm and it is moving to either create liquidity, seek liquidity, or destroy liquidity. So I think I would just type that down. So it is moving to create, to seek, and to destroy liquidity. There is an algorithm, and this algorithm um, helps facilitate institutional orders. And it does this by creating, seeking, and destroying liquidity. So the process of creating, seeking, and destroying liquidity happens just for one reason, and that reason is to help facilitate institutional orders. So that is one fact that I want you to assume to be true for the sake of this class and for the sake of this video. I also want you to accept a new fact, right? A new truth, you know. So I also want you to accept the idea of liquidity resting above every high and below every low. So what this means is I strongly believe that there is liquidity resting above every candlestick high and every candlestick low. So be it the 1 minute time frame, 3 minute time frame, daily, weekly, 1 year time frame, above every single high and below every single low, there is liquidity. There are orders resting there. Now, these orders exist, but it's not every liquidity that has the ability to cause price to reverse, right? So above every high, below every low, there lies or there rests liquidity. But it's not every high or every low that has the ability to cause price to reverse. So what I mean is you see price moving in an upward direction. Hold on a bit. So what I mean is you see price moving in an upward direction like this, right? And let's say price starts moving down like this, right? And we want to understand and we want to believe that there is liquidity resting above this high. There is liquidity resting above this high. There is liquidity resting above this high and below these lows, 1, 2, 3, above this high, and so on. Now, it's not every liquidity that has the ability to make price, to cause price to reverse, right? We understand that truly there is liquidity here, there is liquidity above this high, and also liquidity here. But this high may not have what it takes to cause price to reverse. So price might then seek this instead of this, seek this high, seek to trade above this high, ignore this one, and the liquidity that rests, hold on. So the liquidity that rests above this high would cause price to reverse. So another truth, just to repeat myself and just to make sure we all understand what I am saying, there is liquidity above every high and below every low. But it's not every high or every low that has the potential of causing price to reverse. So the highs and the lows that can cause price to reverse and also present a trading opportunity for us are very specific. And we can identify them by candlestick counting. Let's move forward. Another truth that I would like to share is I want us to marry this idea just for the sake of this class, right? I want us to assume that I am saying the truth. And please, you have every right to go to the charts and study, study and confirm all the stuff that I'm sharing with you. All right. So moving forward, the algorithm creates buy side and sell side liquidity to accommodate institutional orders. So the algorithm intentionally creates buy side liquidity and sell side liquidity. So the liquidity that rests above highs is what we call buy side liquidity. The liquidity that rests below lows is what we call SSL or sell side liquidity. So we have BSL above highs, SSL below lows. Now, the algorithm intentionally creates these pockets of liquidity because it needs them to be able to accommodate institutional orders. So I want us to understand and also marry the idea that there is an algorithm that creates, seeks, and destroys liquidity. And the intention of doing this is to facilitate institutional orders. Now, I also want us to accept something else as true. I want us to understand that for each BSL, there is a relative SSL. So for each buy side liquidity, there is a relative sell side liquidity. So the algorithm creates a buy side liquidity and it also creates a sell side liquidity. Now, when I say a buy side liquidity and sell and relative sell side liquidity and vice versa, what I mean is valid buy side and sell side liquidity. So buy side and sell side liquidity that has the potential to cause price to reverse. So BSL or SSL, that when price trades below the SSL price, we could see a reversal, right? It could present a trading opportunity. That is what I mean. So for every BSL that has the potential of giving a reversal or causing price to reverse, there is a relative SSL. So this has been my approach for a very long time, since I started trading profitably in 2021. So this is how I have always approached the market. Although I didn't start counting candlesticks until 2023, right? But I have always traded the same way, so the logic hasn't changed. So the idea is I identify BSL and I identify SSL. I wait for price to sweep either SSL or BSL. And when price does this, I take the reversal trade. And my target becomes the relative SSL. So if price sweeps BSL, I take the reversal trade, and my target would be the relative SSL. So this is another truth that I want you to accept. Something else that I would like to say is I want you to understand that the very nature of the algorithm, the very nature of price delivery is creating ranges, right? So price needs to create ranges. The algorithm needs to create ranges. And I don't want to go into so much technicalities, but we need to understand that these ranges are pockets of data. Price creates a certain high, creates a certain low, and above those highs, above that high lies data or some kind of information that is useful to the algorithm. It's a bit too technical, but just let us just assume, or try to accept that the algorithm creates ranges. Now, there are different ways that people identify these ranges. Some people mark out their range from a swing high to a swing low. Some people mark out their range based on time. So time ranges from a certain time of the day to a certain time of the day, and that is their range. So they mark out the high and the low within that time frame. So people identify their range by marking out a strong high and a strong low. So they say from a strong high to a strong low, that is the range. Some people mark out or identify a range by doing different stuff, Some use candlesticks, so candlestick ranges and stuff like that. And there is no right or wrong way of identifying ranges. As long as it is effective, then you are correct. Now, I'd like to, using this information about ranges, I would like to state that the way I identify my range is when I have a significant BSL and its relative SSL that is also significant. I assume that that becomes my range. So my range high and my range low. So we can call this a dealing range, right? Because that is where price, that is the range that is currently important to price, right? It is currently important to the algorithm. So when price sweeps the SSL, I wait for reversal confirmation and I take the trade to the BSL. So from one end of the range to the opposite side of the range. So this is what I call a dealing range, a significant BSL and its relative significant SSL. When the algorithm seeks and destroys BSL, it will reverse and seek for its relative SSL within the current dealing range. Within the current dealing range. So from the current high, significant BSL and significant SSL, price would seek for SSL, reverse, and go for BSL, or price would seek BSL, reverse, and then seek to destroy its relative SSL. So that's the idea. Now, to be able to identify, like I mentioned earlier, to be able to identify these BSL and SSL, very specific BSL and SSL that could potentially give these trading opportunities, when one side of the liquidity, one side of the range has been, one side of the range has been targeted and destroyed, to be able to identify this liquidity, we use a technique that I discovered and I developed called that I call candle counting. Now, this is an aspect of candle matrix, right? So don't get things don't get me wrong, right? So this candle counting is not the concept. The concept is candle matrix. So candle counting is just a way to identify bias, to identify liquidity, and to also be able to know the current cycle of the market. In the coming classes, I am going to explain market cycles and the rules behind market cycles. So for now, I am introducing candle counting to the world. So what is the logic behind candle counting? Now that we understand the framework, the algorithm, how it creates, seeks, and destroys liquidity, we understand dealing ranges, specific BSL, and its relative SSL and vice versa. We understand this. Now, how can we be able to identify BSL and SSL using candle counting? Now, trust me, there is no mathematics, there is no algebra, no equations and all of that. It's just simple counting, 1, 2, 3 counting. Now, the idea is to look at the number of candlesticks that it takes to create the range high to the range low. The range high to the range low. You count the number of candlesticks that it takes to create the range high to the range low. Now, it could be just one candle. It could be 2 candlesticks. It could be 10 candlesticks. It could be 25 candlesticks. It could be 150 candlesticks that it takes to create the high, from the high to the low. It doesn't really matter because price is fractal. So one single candlestick on the weekly time frame here could be over 100 candlesticks on the 1 hour time frame, right? So it doesn't really matter. It's still the same idea. So you'd count the number of candlesticks that it takes to create the range high to the range low. That is the first step. Now, the next step is you'll also count the number of candlesticks that falls within the range. So the number of candlesticks that you can find inside of the range that failed to take the range low or range high. So if we have 3 candlesticks from this high to this low, then we also want to count the number of candlesticks inside of it, right? Now, what validates this as a significant BSL and this as a significant SSL is when we have equal amount of candlesticks within the range as the same as the number of candlesticks that it's took to form this high to this low, right? So if we count this and we have 3 candlesticks, for instance, we want to see 3 or more candlesticks inside of the range. We want to see 3 or more. So if we have just 1 candlestick here, we want to see 1 or more candlestick inside of the range that failed to take that single candlestick low or high. So this pattern, to some people, I think they call it an inside bar candle pattern. That is if it is a single candlestick, right? But I don't see this as a pattern-based approach, right? I don't approach it as a pattern, right? Because of the inconsistency of seeing it as a pattern. So the idea is simple. If we have 5 candlesticks, if it takes 5 candlesticks to form the high and the low, we want to see 5 candlesticks or more than 5 candlesticks inside of the range. Now, once we see that, we automatically know that the low and the high will be significant to the algorithm. The low and the high would be significant to the algorithm. And that would be a valid dealing range. Okay, it's very simple. We want to count the number of candlesticks that it took to create this high to this low. So this high to this low, the range high to the range low. We want to count the number of candlesticks inside of here. Outside of the range, that's outside here. Then we want to count the number of candlesticks inside of the range. If the number of candlesticks inside of the range is equal to or greater than the number of candlesticks from this high to this low, then that is a valid dealing range for a potential BSL to SSL run or an SSL to BSL run. Simple as that. So to further elaborate on this idea, I constructed a few candlesticks. Okay. So this is the idea. When we see, in this case, we have 2 candlesticks outside of the range, 1 and 2. Now we have 1, 2, 3 candlesticks that failed to take the high or the low of the range. Okay. So this high here is BSL, and this low here is SSL. Buy side liquidity, sell side liquidity. So when we have 1, 2 candlesticks that formed the high of the range and the low of the range, what validates this range high and range low for a potential SSL to BSL run or a BSL to SSL run is the number of candlesticks that formed inside of the range, right? So we want to see 2 candles like this, since it took 2 candles to form the range high and range low. We want to see 2 candlesticks inside of it or more than 2, right? We could see 3, we could see 4, 5, 10. It doesn't really matter as long as it is 2 or more in this case. So what we want to do, or what we want to look out for, is we want to watch price take out either end of the range. So it could be the high of the range, that is the BSL, or the SSL. Price sweeps the BSL. We want to look for confirmations to sell, to short price down to the SSL. Okay. If price goes for the sell side liquidity first, we want to look for buying opportunities to take price up to the relative BSL, the relative buy side liquidity, just like this. So this is how I am able to identify liquidity by counting candlesticks. So what do you do now? You study. You go to the charts and you confirm this. Now, this is a very broad concept. I call it broad because a lot of stuff goes into picking the right dealing ranges, right? Because there are some times that price would sweep an SSL like this, and to keep going low and low and lower, and it would never ever reverse, right? So there are rules that I have managed to, rules and laws that I have managed to develop to help trade this profitably, right? So for now, with this information, this fresh and new information that I just shared, what I want you to do is I want you to go to your charts. I want you to back test. I want you to check it out. I want you to see for yourself, right? See for yourself, confirm these things for yourself. And I would be looking forward to your feedback. I would be looking forward to your discovery and your comments. So I'm thinking of uploading this class to YouTube. So this class will be available on YouTube. And hopefully I would also extend the upload to my Telegram channel. It is going to be a series or a YouTube playlist where I would be introducing candle matrix. This is the first introduction, candle counting. So we have other stuff that I would be revealing to, like market cycles, SMT, SMT completely different from, it's secret SMT, right? So it's very different from, it's quite different from what we have, the public information on SMT that we have. And there's also something I call candle alignment. I discovered that by myself. And it is also a very, very effective way to time your entries, to get like very high precision entries. So I'll be sharing that in the coming days or weeks or months. I hope this class was insightful, and I will be looking forward to your feedback.